It's Sunday the 16th of May, and I'm here to give you the weekly review on the markets from Centre Asset Management. I'm going to talk mainly about the euro today, because obviously the week has been the main issue, apart from China tightening. I wouldn't want to mention that. But we can see here, obviously, the dollar being the main winner of the week. The euro here losing 3%. In fact, it lost nearly 5% from its peak. The Australian dollar and Canadian dollars, in other words, commodity currencies, regaining some of their losses of the previous week. So we look at the euro dollar, the move of the week. We saw at the beginning a sharp rise in the euro as the announcement, very surprise announcement of the aid package, the $750 billion euro aid package came through. But the market reassessed it and disappointment set in, believing that the austerity measures, the sharp austerity measures that have to be implemented would severely implement growth, and whether it would be enough to repay the debts. And so the euro was sold off, and there's been pretty much a crisis of confidence now in the currency, so that we ended the week at a low of about 123.70 and a nearly 5% drop on the week. If we look at it from a more a weekly perspective, a longer term perspective, we can see that the euro has fallen now quite dramatically. People talk about the euro collapsing. Well, actually it's pretty much coming back towards its fair value, which is, from a PPP ideas, maybe around 120. You can see that in 2001, use the mouse here, we were actually started around 85, we went up to maybe 160, and now we are retracing that. We go from a technical analysis point of view. This looks very much like an ABC correction that should bring us back into this fair value area around 120, maybe down to 115 is possible. So what is really going on? Well, Europe seems to be biting the bullet and forcing the Club Med countries certainly to take very severe austerity measures, which obviously will slow growth in Euroland as a whole. If we just look at Greece, I mean, it's unprecedented what they're up to here. You can see the average retirement age is going from 61 to 65. Public sector wages have been cut by 20%, pensions by 10%, VAT up to 23 from 19, excise tax increases of 30% on gas, alcohol and tobacco. Municipalities to shrink from 1,000 to 400, or intended to, and public-owned companies from 6,000 to 2,000. And a more efficient tax collection system, which of course is vital. And these are serious measures, and obviously the people are not going to like it. The question is whether they will accept it. It seems to be that will be the case. They have to, because there is no other solution. One other thing here was, I think, important, was the visit by the Turkish Prime Minister on Friday to Greece. Again, that will, it seems that they're going to have some agreements there on armaments, on the armaments race that will allow Greece to reduce its budget, its military budget. I spoke a few weeks ago about why Greece needed 6 submarines, and I think that that's quite an important issue. By the way, Greece buys the submarines from Germany as well as Turkey. That's a part of the problem, I would have thought. These adjustments are serious and will be followed by Portugal and Spain. Ireland are already doing them in any case. The euro as well is being sold off as being weak. It's going to help exports, benefit exports for Germany especially, and France. But Europe has to move onto a more federalistic system, and a series of subsidies by the northern states will have to be implemented to help the southern states. That is a move to a more federalistic system that we're already seeing. I think it's the beginning was last week at this historic decision of this aid package. Will the Germans accept bailing out Greece and Portugal in the future? I think they will. I think it's not an issue at the moment, has been because it's been so unfair that the Greeks have basically abused the system in such a way, as well as with bad accounting systems. But if it's done in a fair way, I think that the northern European states would accept the fact that they have to subsidize the southern countries in exchange for a stability and security of Europe. I think this is the beginning of what we're going to see in the future. At the same time, this is the first time the big change, I think, in the way of the borrow and spend last 30 years of its culture is changing. It has to adjust. And the only way it can adjust is by a fall in the standard of living for everybody. Global debt situation is a global situation, and Europe is the first area who's really beginning to confront this. The States are not. The States are continually throwing oil onto the fire and increasing their debt situation. If you think this started, really these bubbles started, let's say, already with Greenspan trying to support the dot-com bubble and then creating the housing market bubble. Bernanke has kept interest rates at zero for the last 17 months. And what's going on in the States? You can see that the revenues, the tax revenues for the government are falling. The only reason they are at the same level of 2009 was through transfer payments. So they $2.1 trillion of transfer payments to the population, and they get that back in taxes. This year, it looks as if their benefits that they're paying out will exceed the tax incomes that the government will get in. So the situation will deteriorate. It's getting worse. Europe has started to confront this. It's not going to be easy, but the States have not. At some point in time in the future, this is going to hit the States in a big way, and inflation is going to come through. So although we see the euro here moving lower towards maybe 115 in this move, after that, we believe that it's going to turn higher again, and the dollar will turn lower. So we're pretty much saying that from 120 we will be neutral on euro dollar, looking actually to go long the euro from a medium-term perspective on rates under 120. That's it. Have a good week.